Amid escalating global trade tensions and rising fears of a US recession that have shaken investor confidence worldwide, we have seen India's benchmark indices, the Nifty and the Sensex, crash over 4% in trade. We've seen global markets plunge as well. Remember, Japanese stocks plunging over 8%, Hong Kong's Hang Seng plunging over 10% in early trade, and US stock futures plunging nearly 6% in trade. Now, all of this is happening. Why? For our viewers to understand, it is because trade war worries are now mounting and fears of a US recession are also now growing. Remember, global brokerages like JP Morgan has said there's a 60% chance of a worldwide recession. Goldman Sachs has in the meantime said that there's a 35% probability of a US recession now, as opposed to 20% earlier. Now, back home in India, investors have lost over 16 lakh crores in early trade alone, and even as investors remain jittery and in wait and watch mode, some analysts are saying that, look, it is time, some are terming this as a Black Monday already. Some are saying we will wait and watch really and see how US markets open. But let's compare for a moment our markets to the rest of the world. India stock markets versus rest of the world. We have seen the US stock futures tumble over 5.5% in trade. We've seen Japanese stocks tumble over 6.5% in trade. China's stock market tumble over 6%. Australia's, of course, stock market tumble over 4% in trade and lose $160 billion as the stock market opened in Australia. And India's stock market tumble over 4% in trade now. So if we compare India's stock markets to the rest of the world, analysts have been telling NDTV that, look, India's macro fundamentals remain strong. India remains resilient. Having said that, India is not insulated entirely from the rest of the world. Now, of course, to decode this further, I'm joined by my colleague Puneet from NDTV Profit. Really, Puneet, investors losing over 16 lakh crores in just early trade in one trading session today alone.
Well, definitely, it is a somber mood today on the markets, and that's, of course, impacted due to the Trump tariffs as a whole. But we've seen now that because of these particular tariffs, and now China also putting a 34% reciprocal tariffs over the weekend, it's essentially, starting a global trade war. And we're going to see a lot of countries impacted because of that. Now, we have seen, of course, sectors which have high export exposure, essentially, sectors such as Nifty, IT is suffering in trade today. We've seen stocks such as Infosys, as well as the mid-cap names of Persistent Systems and Coforge being one of the biggest losers in trade today. While the other sectors that we've seen an impact is, of course, the Nifty metals. The copper stocks are also not doing very well in trade today, and that's largely because of the high export exposure that all these companies have. We've also seen the Nifty Auto today. Stocks such as Tata Motors have hit a 52-week low today. Apart from that, Sona, BLW being the other ones, they have roughly 40% of their revenue coming from the US markets. Some other ones such as Samvardhana Motherson as well as Bharat Forge are down almost 8 to 10%. But we've seen just some slight recovery from, in the morning the lows were much higher than this. So we've just seen some recovery there, but it's a down day in general as well. The other ones, just some impact we've seen on the textile name as well. But overall, it is a trade. Essentially, you could argue that, banking stocks are largely insulated from this, but we've seen a 4% fall on the Nifty Bank as well. And going forward, the company's commentary in Q4 will be one of the key things to watch out for. How is each company trying to navigate this tariff impact going forward? That will be one. And essentially, we've seen the Nifty consumption of the FMCG sector essentially do very well today in trade. It's essentially down 2%, but it's the lowest which is impacted because of this. It's important to see how we go forward in the defensive names essentially of FMCG consumption and banking. But overall, it's a tough day for the markets today, and we're seeing a Trump impact across sectors.
Thank you so much for those highlights. A tough day for markets. I'm joined by Siddharth Bhamre, of course, Head of Institutional Research at Asit C. Mehta Investment Intermediates. I'm also joined by Mukesh Pandey, the founder of RupayaPaisa.com, also a market expert. Thank you both for your time. Siddharth, I'd like to begin by asking you, a tough day for markets, a tougher day for small investors?
Good afternoon, Sakshi. Thanks for having me on your show. Yes, indeed, a tough day for all the participants. Nobody like to, see their investments going down this way. But then, see, there are two different narratives in market, and at some point of time, both the narratives will go right. First is that there would be a global slowdown and India would suffer, and the second narrative is that probably the levies on India are much tariffs levy on India are much lesser than the competing countries in different spaces, and so India would benefit. But what should an individual investor do? Ideally, things should be that if something gets cheaper, you buy; something gets expensive, you sell. Easier said than done, and participants are generally driven by greed and fear. So when market goes up, everybody wants to buy irrespective of valuation. And now when market is offering, some of these spaces where I feel valuations are great, instead of concentrating on the noises, individual investor, whether small or big, should concentrate on businesses which probably can generate a greater shareholder value. And I see a lot of pockets which are now attractive. So not necessary that they won't correct at all from here. I think individual investors, small investors should think of investing money in this kind of market. This problem is not going to be greater than COVID. This problem is not going to be greater than 2008 scenario. And generally, when market gives you opportunity, everybody's fearful, and I'm sure today people are fearful. But the essence would be, the key point would be that how you overcome your fear and think rational. That would set you apart from the herd.
Right, Mukesh Pandey, do you agree investors need to overcome their fear, and what must small investors really focus on? You track the loan market, you track the financial market. Small investors really who are planning their finances, what should they focus on a day like this when we witness steep declines across the board? Mukesh Pandey, if you could please unmute yourself. What should small investors focus on?
Yeah, exactly. Small investors should focus on more doing in strategic investment, doing studies, studying the market. Accordingly, they should plan their strategies for investment in the market, because this is not, as the fellow member said, this is not going to be as bad as it was during the pandemic or 2008 recession. And India, on a positive side, as the tariff imposed on India is on the lower side as compared to the market, other countries. So it is an opportunity also. It should focus more on technology adaptation and focus on more strategic investment in the market.
Right, it's also an opportunity. Siddharth Bhamre, do you agree? And also, what sectors then should bring the silver lining really for investors, as it were?
If you are a weak-hearted and you can't see, any red or any big losses in your portfolio, then the answer is simple. And I'm not saying something which you haven't heard on street, that concentrate on domestic revenue generation companies. Now, just case in point, two sectors which we are actively tracking. Paint companies have done really bad in last 2-3 years, and there are multiple factors. Be it, consumption has been, the growth has been less, competition has been high, and they are trading at historical low valuations. And now we are seeing that there is turnaround happening in paint companies. None of the paint companies is into export market. It's totally driven by domestic consumption. So this issue will not impact them. And obviously stocks have done better in last 2-3 months compared to market. And I think they can do better from here on. The other space which we are actively, suggesting to our investors, which has nothing to do with export and this tariff thing, is insurance space, life insurance space. Again, this sector has been in turmoil because of a lot of regulatory changes. Again, there are certain changes which have happened. There has been huge change in commissioning structure. So last 2-3 years, 4 years, these stocks have not done that great, but earnings have gone up, which have made these stocks attractive in terms of valuation. So whether these two sectors, or we can talk about more space, but for paucity of time, I would say that in such kind of market, you do bottom-up approach, see that these sectors are good, these stocks are fairly valued, then let market takes its due course of action. Your stocks over a period of time will do well. So my idea over here is clearly identify different sectors. Now there are sectors where there can be exposure in US, or can be a lot of exports is there, but are still attractive. Now this would be very contrary to what you're listening to a lot of participants in market, Sakshi. I think IT is at an interesting juncture where valuations are very cheap. Obviously, the story seems to be bad right now because if US goes into slowdown or if there is a global slowdown, if there are tariffs, then IT will have problem. But look at this. If US is doing this to strengthen itself and its economy over a period of time, IT companies will get more business over a period of time. Yes, there will be short-term challenges, but at that point of time, you won't get these valuations of TCS available less than 25p, Infosys available less than 23p. So a contra investor can think of investing in IT also. But yes, there can be a short-term volatility in IT, and you can see some downside. So depending upon how much risk appetite you have different investment opportunities right now in market.
You of course are predicting near-term volatility. Needless to tell our viewers that we've seen the volatility index spike around 55% in early trade today alone. So really a lot in wait and watch mode, as I guess we're mentioning. That's as far as the market mood is concerned at the moment.